Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month copper, aluminium and lead. LME 3-month copper. Once again, I feel obliged to state, as I have now for many months, that there are 3 important congestion zones, which in turn have become either important support zones or resistance areas, and impact on this market. Above the current market is the highest and possibly the toughest of these congestion zones, between 97.50 to 99.95 area, although very recently prices have managed to stray above it, only to each time get slapped down. Today we are edging up and out of the middle zone, in the 93.95 to 96.06 area, which at the moment contains the slowly declining mauve medium moving average, currently 94.81, and just entering from below the short medium moving average, currently 94.09. Finally, below is a smaller one, between 91.83 to 92.56. This last one saw the market push up through it 9 weeks ago, then get capped by the next congestion, the 93.95 to 96.06 zone, plus at the same time the declining short medium moving average, and we ended up back down below it again before 5 weeks ago tackling it once more and 4 weeks ago pushing up through it. Prices then traversed the free area up to the 97.50 to 99.95 area, where we tried pushing even higher for nearly 2 weeks. However, 2 weeks ago prices started their journey back down, pushing below and out of the 97.50 to 99.95 congestion area and into the 93.95 to 96.06 congestion zone. Last week prices made a major decision. They pushed down below the lower time, currently 97.74 of the previously breached topside early August to early September bullish Andrews pitchfork, which I drew 5 weeks ago. And I said at the time, and I quote, "I am not in love with this pattern, even if it is the first bullish pattern of note I've drawn for quite a while. I'm quite prepared to finesse this into a shallower bullish shift pitchfork or even retire it completely, but for now it is doing its job of showing a nascent bullish angle of attack higher." End of quote. It is now failing at its job, such that I think if it wasn't for the mauve slowly declining medium moving average, prices might have been a lot lower. This mauve medium moving average managed to hold up the market last week enough that we had a test up to the broken lower time this week, but that attempt higher has seemingly failed, at least for now. It seems that I will have to go back and rely on the 3 congestion bands. There is one other major difference between now and what I said 5 weeks ago. The market is no longer has the option to finesse itself into a shallower bullish shift pitchfork. That opportunity no longer exists. LME 3-month aluminium. There continues to be a lot going on here on this daily chart. The move higher over March, April, May, and I suppose even the most recent one from early August originates back to late February, with the market breaking higher from a diamond pattern type formed over back then between late October 2023 to late February 2024. Now please remember this, as it is the congestion generated by this diamond pattern on the Y between 2100 to 2400, but really between 2156 to 2297, that caused the very recent rise since late July, though obviously not the original pattern itself. Okay, so the decline from late May to late July was stopped by the extension to the neckline, currently at 2217, of the June to July 2023 reverse head and shoulders neckline pattern. From this base, prices started building and experimenting upwards from the same price zone as that earlier diamond bottom pattern, roughly between 2400 to 2100. In the process, pushing up through some significant resistances now turned supports. The nearby notable ones were and are the congestion zone from mid-June to mid-July between roughly 2485 to 2563, containing the key levels at 2485, 2508 and obviously 2563, plus the bright red middle time, currently 2558, of the mid-December 2023 to late July this year, shallowly rising bullish shift pitchfork. I also drew 4 weeks ago a shallow bullish shift pitchfork for the late July to early September move. And I said at the time, and I quote, "This last one I'm happy to finesse or even retire as the market demands." End of quote. Well, the market originally demanded I finesse it to a more acute bullish Andrews pitchfork, but after a while this stopped working, and so I've gone back to the bullish shift pitchfork, breached as it was on the top side back in early October and highlighted in dark blue on my daily chart. When looking at this market's actions, I said 3 weeks ago, and I quote, "All this is making me think that just perhaps the market could do with a bit of a rest now for any fresh attempt higher. I have nothing behind this other than a fear of an overextended market not being able to generate energy for any further attempts higher." End of quote. Well, my fear of an overextended market has been borne true, as we have dropped 2 weeks ago all the way down to the December 2021 low at 25.81 and close to the bright red middle time before pulling back up, and then last week turning back down again before seemingly trying to move higher this week. All this activity left behind one pattern, a September to early October ascending wedge pattern. This pattern left a primary target down in the 25.85 zone, which was reached 2 weeks ago, and a secondary hard to reach target X1 down in the 24.55 zone, which the market has studiously ignored and will be retired after this commentary. So after all this back and forth, it seems the market is trying higher, utilising the bright red and dark blue middle times as a base of sorts. This leaves us with the congestion overhead, primarily the big old 50% Fibonacci line of the 2008 to 2022 move at 26.75, but assisted by the August 2011 high at 26.66 and the 2023 high at 26.71 as the resistance that is capping prices. It will be interesting to see if this cap is as strong now as it was back in early October. LME 3-month lead. There are a number of significant features on this daily chart. The first I'd like to mention is the immediate overhead wide band of congestion originating from April between roughly 21.35 up to 21.86, a congestion area that showed itself at the peak 8 weeks ago and again over the start of October. This area contains the 50% Fibonacci line of the March 2020 to March 22 move at 21.35, the nearby long moving average currently 21.25, and edging below and out of it the mauve declining medium moving average currently 21.02. The next is the late July to late August reverse head and shoulders pattern. It's far from a pretty one, and I'm loath to even mention it, but it does exist, and that rise peaking 7 weeks ago was all it could achieve, but it did lead to another pattern, which I will discuss shortly. First, I'd like to detail some of the supports below, some of them well below Fibonacci based congestion and otherwise. And that's between 1994 to 2002, followed by the June 2023 low at 1976, which looked, how shall I put this, less interesting, and then the 2024 low in August at 1917, which I suspect is a function of the nearby 2021 low at 1908. There's also a neckline extension currently at 1944 of the July 23 to February 24 head and shoulders continuation pattern. The reason I mention these supports below is they contributed in eroding the decline we saw in early mid-September, enough that it was stopped and turned back upwards, and brought about what I mentioned earlier, a new pattern, possibly even two new bullish patterns. Originally, we had a bright red early August to early September bullish Andrews pitchfork. However, 2 weeks ago I finessed this to a shallower bright red early August to early September bullish shift pitchfork. The market is right now just above, or just below actually, it's just dropped down below it, the middle time, which is currently at 20.79. The second pattern, here I'll quote from 2 weeks ago when I said, is the almost ready though not yet triggered mid-July to date double bottom. This has a neckline in the 21.35 to 21.40 area. End of quote. Well, this pattern continued to be not triggered, enough that I'm considering reappraising it. I said as much 2 weeks ago when I continued, and I quote, all it would need to kill these two would be the market to just go sideways and open up the possibility of a shallower bearish shift pitchfork and even a triple bottom. So just watch carefully. End of quote. Initially we did not go sideways, but instead actively headed lower, but over last week and a part of the week before and even this week, This move lower has been tempered by, of all things, the green highlighted short medium moving average, currently at 20.59, which has caught the decline and cradled it somewhat. This does not mean that we have stopped heading lower, as after all, only 2 weeks ago we had a weekly reversal down, but it does point to some hesitation. The question now is whether this hesitation is part of a bear flag type action or a new base for a possible attempt higher. It just seems that both topside and below we have some considerable resistances and supports, which I detailed earlier, and I suppose that is why the market is seemingly making time right now, or marking time I should say right now. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.